What's up everybody, Nate here, and it looks like the housing market in the United States is doing everything and anything it can to get jump-started once again. Mortgage interest rates have once again started to drop in the United States, and homebuyer demand is rising just like it did in 2021. Not only that, but home builders are starting to step in and help real estate investors and potential buyers with their mortgage payment. And for many sellers, this looks like it might be the very last chance they get to sell their home for a very long time. So today I want to break down everything that is happening in the housing market and what we could eventually see from it in 2023. One of the most interesting things I'm seeing in the housing market right now is from home builders. Now, home builders have taken a huge hit from rising interest rates and really low demand over the last couple of months. They are part of the reason why we have a lagging supply of homes in the United States. Home builders and home investors kind of exploded in 2020 and in 2021 because there was so much demand. They were building houses so quickly, in fact, that a lot of the materials to build a home also started to skyrocket, which meant those homes were getting sold for even larger amounts. But homes take a long time to build, and because of a lot of those supply chain bottlenecks due to demand, a lot of homes actually got put on the sideline, meaning we had even fewer homes than expected and even higher demand, which again made prices explode throughout the country. Right now we're seeing an interesting phenomenon in the housing market. Home builders are actually proposing that they help a potential buyer out with their mortgage. They are willing to front around 3 to 5% of the purchase price if someone is willing to buy their home. In fact, about 32% of home builders are actually buying the homes themselves. They're actually going in on a 30-year mortgage, holding on to this house and reducing the price and the interest rate for it until somebody is ready to buy it. Another 30% of builders are willing to actually reduce the interest rate price with the bank for buyers to actually go in and purchase that property. That means for around the first couple of years, that interest rate is going to be a whole lot lower, which means buyers could end up saving around 1 to 2% in their interest rate for the first 24 months, which could end up being hundreds if not thousands of dollars. Not only that, but builders are actually going in and putting down tens of thousands of dollars on these houses to kind of incentivize more people to buy them. Now, this is kind of an interesting situation because we've never seen builders, at least not to the scale, go out and buy their own homes or help millions of borrowers actually purchase those properties. That is just a sign of the times though, because mortgage interest rates are still way too high in the United States and home prices are also way too high as well. So that means affordability is in the basement. Many Americans just simply can't afford a home, and what that means is builders are now sitting with an empty home. They would rather pay a little bit more money up front to fill that home rather than just have hundreds of thousands of dollars just sitting in a lot. But this also has really interesting implications for our future economy, because if you look at what happened back in 2007, just before the great housing market crash, you will see a huge similarity. Many people that were purchasing a mortgage at that time got an adjustable rate mortgage. That means every so often, usually 5, 10, and 15 years, that mortgage is going to reset, and depending on market conditions and the interest rate from the Federal Reserve, that interest rate is going to be a whole lot higher. Many people purchased their house and got an extremely low interest rate to start, but after 5 years or so, that interest rate reset, and now they were in a really tough situation. Their mortgage payments essentially doubled or even tripled, and millions of people no longer could afford their home. They ended up going into foreclosure. Now, how exactly is this similar? Well, we're starting to see builders kind of slash that interest rate by around 1 to 2%. That means people are going to buy this home, and in a couple years from now, that interest rate is going to go up. Even though they might realize that interest rate is going to go up in time, well, they might still not be able to afford it in the future. You have people buying houses right now that can afford it at that lowered interest rate, but nobody knows what's going to happen when that interest rate goes up, especially because nobody knows what's going to happen with the future of our economy. There is a lot of talk right now that we could potentially see a recession in 2023, and if we do, nobody knows how long or how bad that recession is going to be. A recession could lead to job loss, and it could mean a lot of lost income for Americans, and if they start losing their job, they're no longer going to be able to afford that mortgage. In addition, if the housing market continues to stay hot, then more than likely we're going to see insurance and taxes rise for all of those properties that people are about to purchase, meaning their monthly or yearly payments are going to go up anyway, and on top of that, their interest rate is going to go up in the future. If people lose their jobs, if they have to pay more on their mortgage, and all of a sudden that mortgage interest rate goes up, now we've got a serious problem because millions of people may no longer be able to afford their house. And all of those builders and all of the mortgage-backed securities and real estate companies and banks are also going to lose big here. The other thing that we could eventually see into 2023 is on the real estate investing side. If builders actually start helping out real estate investors to purchase these homes, then that could mean housing prices stay hot for the extended future. And it could also mean that a lot of real estate investors lose money if economic conditions start to shrink. Because right now, real estate investors and Wall Street and firms like Blackstone and BlackRock have been pulling out of the housing market because demand is going down and interest rates are rising. So they're not able to get that same return on their money, so REITs and real estate investments in general are going down. They're selling those properties, they're going to foreclosure, whatever it may be. But if we see a little bit of an uptick in demand, or we have builders actually running in and providing a lot of that liquidity for investors to re-enter the market, that means that investors may be a little bit more inclined to also buy homes. Again, these are all incentives to kind of help out a struggling housing market because we had this huge boom and now billions are being lost in liquidity for Wall Street firms and millions of Americans are no longer able to afford a house. Now, the other thing I want to talk about is with interest rates themselves. Now, we have started to see interest rates slowly go down in the United States because the Federal Reserve has kind of indicated that it's going to slow down raising its rates in the future, and inflation has also started to drop. Both of those things mean that banks can be a little bit more lenient on who gets a home. Over the past few months, interest rates have gone way up, and that is directly related to the Federal Reserve. The Federal Reserve has been raising its interest rates to kind of combat inflation and lower demand. The higher their interest rates go, the harder it's going to be for anybody to borrow money. That includes people looking for a mortgage or an auto loan, or people trying to spend on a credit card, or investors on Wall Street and businesses. Anybody that needs that extra liquidity through debt or a loan is going to have a harder time getting it the higher the Fed's interest rates are. Over the last couple of years, they were extremely low, near 0%, so that kind of fueled all of this investment and consumer activity in the housing market. But now interest rates have gone way up and many people have just left the market. But if there is a chance that the Federal Reserve may slow down its interest rates in the future, well, then banks know that they're not going to be paying as much money to get their money from the Federal Reserve. If banks don't have to pay as much on an interest rate from the Fed, then they're also not going to make you pay as high of an interest rate. They just have no reason for it. Meaning interest rates for a 30-year fixed mortgage on average are slowly going down in the United States, and that has meant that an uptick in demand has finally happened. More and more buyers are starting to enter the market because they see this as potentially the last chance they're going to be able to get a house for the foreseeable future. I mean, again, nobody knows what's going to happen with inflation or our economy, and the Federal Reserve has to be very strong on inflation right now. So they want to kind of tighten everything in our economy by raising those interest rates. The same could be said on the seller side. With demand going up, sellers believe that this might be their last chance to finally sell their home. And again, all of that is linked to affordability. So because over the last couple of months, interest rates have been really high, prices for your top 10 and even your top 50 real estate markets throughout the country have decreased in price by around 5 to 15%. That saves people a little bit of money when they go into that mortgage. But with interest rates now also dropping too, that means many Americans can finally once again get a home. I want to stress here, they are definitely not low enough for millions of people to enter the market all at once like we saw over the last couple of years. Prices are still way too heavily inflated. They're not going to come down unless the Federal Reserve raises its interest rates even higher, which they are most likely going to do next year. And same with actual interest rates right now. And like I said before, that all controls demand in our economy, and eventually with demand coming down, that will give supply hopefully time to grow. And if builders can continue to build homes and then these incentive programs actually work out for them, that could mean supply grows even faster and more people can enter the market. This is all a big deal for the housing market, and it's a little unusual because winter is usually a very slow time for the housing market in general. But what we could be seeing right now is the very last housing market boom for a very long time in the United States. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.